Hello, everyone, and welcome to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way to exit your highly appreciated assets tax deferred so you can create, preserve, and grow more wealth. I'm your co-host, Pearson York, filling in for Brett Schwartz. In each episode, I'm joined by some of the best wealth, business, real estate, and leadership individuals in the world. Share ideas, deal stories, and inspiration so together we can make complex tax deferral strategies simple and passive income plans achievable. As always, we are streaming on expertcresecrets.com, the Capital Gains Tax Solutions YouTube channel, the Kingdom Luxury Realty YouTube channel, and the Kingdom Luxury Realty Facebook channel. So please rate, review, subscribe, like, share, all that good stuff. It really helps us out. I'm really excited about our next guest. She's been in real estate for the last 20 years. She's now developing a $100 million multifamily fund. And we're going to have a fantastic conversation about cost segregation and how to avoid some taxes. So, Miss Jennifer Joyce, how are you doing today?
I'm doing well. Thank you for having me on the show. I really appreciate it.
Yeah, absolutely. So, how did you get into real estate?
I'm actually second generation. So my mother was a school teacher, but she kept every house that she ever lived in. So she would either own or finance it or rent it. And she didn't work in the summer being a school teacher. So I was the trash out team, the make ready team, the lease up team for most of my childhood. So naturally, when I became an adult, real estate wasn't scary to me. And we started out with, like most people, in single family homes. Then we moved to small multifamily. And then about 5 years ago, we jumped over into large multifamily leveraging syndication.
Awesome. So, a lot to unpack there. But before we do, I want to just kind of dive in a little bit. And, I believe everyone has a certain set of spiritual gifts or strengths, superpowers, what have you. What are one or two of your strengths or superpowers?
I would say probably the one that comes to mind more than anything is anticipator. I can pretty much tell you 5 cars up what's going to happen in heavy traffic scenarios, and it's kind of the same in business. So, if I see a business plan unfolding and, we see some problems up ahead, we can go ahead and put those bowling alley bumper lanes on and avoid all of the pitfalls along the way, and create another business plan within a business plan for those items. So I really enjoy this because there's a lot of pivots in business.
Yeah, absolutely. So your ability to anticipate what's coming up and then be able to put contingencies in place so that you're prepared for what's going on in the future, protecting your investors and your business plan altogether. That's awesome. So that means that you're the first person I've heard that has the crystal ball that's out of the shop and ready to go. So I'm definitely going to be asking you about that a little bit later on in the show. But I want to kind of dive into the meat of this. And so you do cost segs.
Yeah, so we leverage cost seg in our large multifamily investments. It's definitely something our investors are looking for. They want to see for every dollar invested that 60 to 100 cents on the dollar comes back to them as a paper loss. They may be trying to offset another business, other real estate transactions, or passive investments elsewhere with commercial real estate. So one of the things they really look at on our deals is what our pro forma looks like for that cost segregation study, so we can pull a lot of those tax deferred dollars forward.
Yeah, absolutely. And for those of people who don't know what a cost segregation study is, do you want to explain that?
Sure. So we hire a team of engineers that go and pick apart our buildings, and they put them into buckets based on what we're talking about. You've got sticks and bricks, you've got paint and countertops, and you've got everything in between. And those can actually be bucketed into 5 year, 15-year, or 27.5 year buckets for depreciation purposes. But under the Trump administration, he actually created a new rule that allows us to pull a lot of that depreciation forward into the first year. And so now this is a strategy that people use across the whole commercial real estate space, and sometimes even in single family portfolios, where those engineers can tell you how much of those depreciation dollars can be brought up into year one. We saw this before the Trump tax law, kind of in the SUV or large truck space, and it was called a Section 179, where you could pull the whole value of that truck purchase into the year you bought it in. So a lot of business owners would go buy a new vehicle and then depreciate 100% of that asset in the first year. It's very similar to that. The one problem with what we're doing is it's going to taper off after this year.
Yeah, definitely. So for those of you who are possibly new to the show, just a quick overview of the depreciation. Typically, you have a building that you can write off a loss at, 27 and a half years. It's called a straight line depreciation. And what a cost seg study does is it basically allows you to put the stuff that's not going to last 20 years, like a light fixture, right, in a different bucket, like you said, and write it off earlier. So you can take some more up front and you deal with less on the back end. So now, since you kind of talked a little bit earlier about your ability to anticipate and whatnot, I'm gonna dive in because I'm really curious. What are you guys planning to do after this bonus depreciation kind of starts tapering off, and how are you guys pivoting?
So a lot of it is using the tax-free strategy called cash out refinance. So we have a lot of assets that we've implemented new efficiencies into. We've pulled the bad efficiencies out. We've created more value in these properties showing in the net operating income. And now we have an appreciated asset that we could either sell or cash out refi. Well, a sale is a tax event. The cash out refi is not a tax event. So it makes sense going into this next part of the economic cycle, if it's possible to protect the asset with not pulling too much out of the asset for a cash out refi, but some of it, those dollars can be given back to the investors tax free, and they can take those dollars and reinvest them elsewhere.
Yeah, and that's an awesome strategy, right? And so what happens when you guys have kind of so you're now doing multifamily syndications, right?
Yes.
And what type of assets are you going after currently?
We're going after everything from distressed all the way to core plus. So that's 1960s product all the way to the early 2000s product. We look at the whole gamut. We just put a different business plan on that product depending on what its needs are. And there's lots of reasons for that, but most of it's around diversification. So we want the older stuff that has more cash flow, but requires more sweat equity. And we want the newer stuff that requires less sweat equity, but has lower cash flow and is more secure. So we look at a diversification play.
Yeah, absolutely. Okay. So that makes a ton of sense, right? So going back to, this idea of cashing out refi, like we like to say here in capital gains tax solution land, it's a lot more about tax flow, nowadays than ever before, and tax flow versus cash flow, right? Because it's not how much you make, it's how much you keep. Right. And so if you can cash out refi and pay off your investors, are you building that into part of your like pro formas now when you're looking to raise capital? Like, okay, we're going to cash out this property, we're going to pay every investor back. And then are they walking away? Are you still letting them be in the deal? How are you structuring these things?
Most of the time, we do not project a cash out refi into our underwriting model. We want the deal to stand on its own with cash flow without that event. So we come up with a 5-year business plan that is just an entrance, an improvement, and an exit. And we do that on purpose because then it's a worst case scenario for the investors. If we get to year 2, 3, or 4, and there's a possibility that you can do a cash out refi and retain the asset, then you could possibly take our investors to what we call an infinite return, where they've taken out 100% of their initial investment. It's a tax-free event. They're still going to cash flow on that asset post refi, and now they're able to diversify themselves. So it's our strategy to do cash out refis, but not project those in the initial numbers, which actually makes the deal look better than it should. So I shy away from deals that have cash out refis projected in the plan for that reason, unless it's a distressed deal or ground up development where that's kind of required.
I think that's really wise. And especially as you're seeing right now, like how are these, taking interest rates, right, going to affect that whole business plan, like altogether, right? Because before you could get, 4% on a, maybe 5% on a loan, but now up to 7, 8, 9, 10, 12% on a loan, it totally changes the game.
Yeah.
So you don't want to cash out refi because the benefit is not going to be as great as the amount that you're going to have to pay in the back end. So what are you guys going to do when that happens, and how are rates affecting your guys' models?
So once again, we want the deal to stand on its own legs on the first loan. So if we were in an environment where we're at 7-8% loans, and that's all you can get in the space, your investors are going to have a lower expectation of cash flow in that situation as well. However, that is worst case scenario. So if I'm able to come in later after I've stabilized the product or improved the product and I can get agency financing and do a cash out refi, those interest rates actually trail behind the rates we're using to acquire assets. And what you can do is actually lower interest rates into something more secure in year 2 or 3. So, in an environment where we didn't see this happening 2 years ago when we bought something, and we're in that environment today, the best strategy for us is to go into a sub 3 interest rate on a Freddie Mac or Fannie Mae deal. And
Yeah.
then we've locked in even better terms than you can get if I bought the property today.
Yeah, no, that makes a lot of sense. So I really like that whole model. So are you guys liquidating your assets at all?
Only if they've reached some of the metrics for the area. They're outgrowing their area. So it's a location question. If the location is strong, the sales price of homes is strong, the median household income is strong, you've got population growth and economic growth, we're going to keep those assets. We're going to hold. But if all of those things have played themselves out, you're at the top of the market, you've tapped out the most amount of rent you possibly can, those are the deals that are probably going to experience some struggles here in this next part of the economic cycle. And we want to go ahead and exit. So it's really about location and the data surrounding that property.
So when you exit, with these, syndicated deals, how are you going to handle the capital gains tax at that point?
So we actually have learned that there's a new strategy out there where we can, as syndicators, 1031 the shares. If someone was to go into one syndication and put their money into the next syndication, and the ownership group is willing and able to facilitate a 1031, then
Yeah.
all of our investors can come alongside us and 1031 or not. They can opt out of that 1031 exchange, but then somebody who put 50 in, got 100 back, and wants to take their 100 in through a 1031 could come into something new we're buying that allows for that type of structure.
Nice. And yeah, so that, I mean, through a lot of different conversations with, syndicators and whatnot, a lot of them will choose not to do that just because of how intense the paperwork is, and some of the, legal issues that you got to kind of like go around and structure and make sure. It's just a lot of work. So they have put like a threshold on, how much money can come in, or how much money you have to have, like a minimum, right, in order for them to go through and facilitate this 1031. Are you guys going to have a minimum like that, or are you guys just going to go all for it?
No, I think the GP team is taking enough equity off of the deal themselves that it's beneficial for all parties that want to opt into the 1031. So we don't have a threshold going to become more and more common to do that strategy. So I think the price point's going to come down. And then the amount of paperwork, we have third parties that do it for us. So we're just paying a flat fee, and we're paying for closing costs anyways. There's no reason we couldn't have an additional fee to facilitate that.
Nice. Yeah, that's awesome. So, okay, so what has been your biggest frustration with the 1031 then?
There's no sense of urgency behind the 1031 groups. So, when you need things to happen by deadlines and you need them to happen quickly and you need paperwork pushed efficiently, it's a lot more sweat equity than you may have initially realized. And that may be what you're alluding to earlier, is the amount of paperwork isn't really the problem. It's the time commitment in that short window.
Yeah, so we asked this question a lot on this show, and it's not that we don't like the 1031. We do. I mean, the 1031 is great if for certain people, right? Where we find it has some restrictions and some challenges is that in a fully, peaking market, right, where you're just totally ascending and you are liquidating an asset at the peak, right, and then literally at the 6 months later, you're buying at another peak, it's hard, and you have 45 days to identify, you have 180 days to close. And if you don't find those properties, and you got to go back into real estate, if you can't find an up leg, you got to pull it out and take the tax. A lot of people have that. We've also heard from a bunch of different, syndicators and whatnot, that if everyone doesn't want to move with you, then the 1031 is shot, right? And it kind of screws the pooch on everyone if you're trying to move a team over into another property. And so there are some challenges with it, right? If you can find an up leg that makes a ton of sense, and it's a great deal, it's a slam dunk, like, yeah, we're like all for it. Like, it's phenomenal, especially if you're trying to upgrade. But we've just found that those challenges. And so what we use is the Deferred Sales Trust, which is just an alternative to a 1031. And it allows you to liquidate the asset, and not just real estate. It can work for business or stock or crypto or primary home or commercial real estate. It doesn't matter. And it's like kind of agnostic. So you don't have to go back into real estate. So you can sell, a primary home, and you don't have to do a 121 exclusion. You can defer all the capital gains tax. You can invest it in stocks and bonds, and just wait and keep it liquid, and some Bitcoin or whatever, right? If it's at 25,000, like right, last week, or whatever the case is, right? And then when you find that great deal, then you can go back into real estate when you want. And so it also works great for syndicators, because you can break up the syndication, and each person, Mary, John, and Joe can each, do their own deferred sales trust, or they don't have to, kind of like what you're talking about with the 1031. So it's just less issues, less paperwork, less timelines, less all of those things, that gives you flexibility, control over the timing and diversification and cash flow and all stuff. So that's kind of like our what we have kind of since graduated to above and beyond the 1031. And that's why that's kind of what we do. And you guys can find out more about that by going to capitalgainstaxsolutions.com and starting. We also have a mastermind every Friday at 10 a.m. Pacific, 1 p.m. Eastern time, which Jennifer, I will definitely be sending you an invite to that, so you can come and check it out and see how this thing works and whatnot. So you guys can sign up for that at capitalgainstaxsolutions.com as well. So yeah, there's our shameless plug, right?
No, it's fine. I actually know quite a bit about DSTs, and I highly respect the program. I've seen 7, 8, 9 figures flow through those programs, and I think they're highly effective for people who are trying to re-strategize, slow the market down, get dry powder for what's coming. I think it's a great strategy. We're more active in the space, so we're constantly in acquisition mode. So the 1031 makes sense to us. But if I wanted to slow things down, halt all of our purchases, the DST would be something I would strongly look at. It's also one of the reasons we have a blind fund, is as assets enter and exit, they're still just in the fund level. They're not actually in the investor's pocket level. So that kind of helps with taxes as well. But if they were going to go behind the scenes and strategize taking out $1 million out of the fund and put it into a deferred sales trust, that's a highly efficient vehicle, in my opinion, for this next season that we're headed towards, to protect those dollars.
Yeah, absolutely. So it sounds like we're a lot on the same page with that. So speaking of the fund, so you're developing a fund, or you already have a fund developed?
We have a fund developed. We have a blind multifamily fund. It's got 5 assets in it right now. We're not done purchasing, but those are going to go through capital events themselves, and then the investors can decide inside the fund if they want to take 100%, leave 100% in, or a hybrid. And so that gives them some flexibility over their tax scenario as well. And then if they want to build it up, they could take it into a deferred sales trust when we sell everything off at the end. So that's a great way to use the two strategies together to kind of mastermind around the tax scenarios out there.
Absolutely. And that's exactly what this whole podcast is about, right? It's about learning about these different things, these different, funds and whatnot that, we can use to, partner up and be strategic alliances, and, we're all better together, not, and so, not having the plan is the enemy. It's not any one of the other, people. So what do you think is going to happen here in the next Few years.
Lots of receivership.
Yeah.
So we're going to have a lot of distressed deals that can't handle the property tax hike, can't handle the interest rate hike, can't handle the labor hike. And so people are going to buy wrong. And if they don't have a pivot in their plan for any of those things, it's definitely going to impact the investors. And that's going to cause the SEC to come in and take a closer look at what all these operators are doing and come out with some new regulation we none of us need. When really it was the economy that impacted a lot of those deals were going to be scrutinized by the federal level. So anything you can do to kind of revamp your business plans out there, multifamily community, let's get those plans in action today because it's all coming whether we're ready or not.
What kind of pivots are you guys making?
A lot of it is the cash out refi play. So what we're doing above and beyond the cash out refi is if the debt space is saying 7, 8, 9%, but we're able to lock in a 2, 3, 4%, that's a advantageous sale for us. So we could actually let a buyer assume that loan with that better debt in place and take over an asset at market. So they'll still pay full price for the asset, but they don't have to have question marks around the debt. It's already locked in for them, and we do it ahead of time so that we're improving those numbers on their behalf to make it best foot forward for their hold. We're also looking at holding things long term. We usually have 3 strategies, no matter what part of the economic cycle we're in, where we have a short-term hold, a long-term hold, and then a cyclical refi scenario. And at each refinance, you can infuse new CapEx dollars into those multifamily assets and improve them that much more. So we might actually segment part of our business plan at capital events where we don't have to do all the improvements all at once. Maybe we do the first phase is inside, the second phase is outside, and the third phase is positioning for sale. So there's a lot of strategies we do just based on the location and what the economy is telling us as time ticks by.
Yeah, and what markets are you buying in?
Mostly Sunbelt states. So we're Arizona, Texas, Florida, Georgia, North Carolina. We'd love to be in the Tennessees and have more in Florida, more in Texas, of course, from migration. But you kind of follow the numbers, and so we eliminated half the country due to legislation, and the other half we're looking at their economies on a submarket level.
So you're not coming to California?
I'm not. I'm so sorry.
Are
No,
you
and I
guys
say this all the time about Boston. I say you can make money in Boston. You'll just spend more time doing it. So if your goal in life is to use a bunch of sweat equity to make a Bostonian property wonderful, you will cash flow. I just don't want to trade that much time.
That makes a ton of sense. What are you guys doing? Any sort of like redevelopment deals, like hotel redevelopments into multifamily, like that type of thing?
We're looking at it. We want to make sure that we're not over inventorying a certain area. So it's got to be the right hotel in the right market that's already got such a housing shortage, they have no choice. And then you've got to have really down to the city level, you have to have a city that is willing to work with operators like us. And they're not trying to, I guess, put the power play on the people coming and saving the day. Because those cities will get a reputation for not being willing and ready to work with people, and they won't have the demand supply chain issues handled. So it really boils down to your municipality at that point.
And you guys are operators as well, correct? Not just syndicators.
Yeah, we definitely are hands-on. We still leverage third-party property management for most of our assets. We do have the ability to own or operate ourselves. We're vertically integrated on some of our locations through other parties and partnerships. But we had a scenario during the pandemic where a third-party property management company completely disappeared on us. They were pulling all their people into corporate meetings to discuss health and wellness and regulations and all the way down to the property level and wouldn't return anybody's phone calls. So we became owner operators overnight, and that was fine. We locked arms with our property manager, and we came up with the YouTube videos. We came up with online applications. They came up for air about 6 weeks later and said, "What is it that you're doing? This isn't what we do at our company." And I said, "Where have you been?" We had to go on without you. I'm sorry, all of this has been implemented. So
Yeah.
that's really great that we have that owner operated background because it really helped us in the middle of the pandemic.
Yeah, absolutely. Okay, cool. So where can people find you if they want to get involved?
If they want to get involved, my personal cell phone number is on my website, so I just encourage everybody to go there. It's a very friendly community. We all talk to one another all the time. So www.jjcapitalinvestments.com is a way to reach out and connect.
Awesome. And it's up there on the screen now, jjcapitalinvestments.com. Um, awesome. Okay. Well, we are kind of running out of time here. I wanted to kind of get into the lightning round. So I'm going to just fire off a couple questions for you, and we'll go from there. How's that sound?
Sounds good.
Awesome. Okay, great. So what is your favorite leadership quote?
Take people to the top of the mountain with you.
That's a good one. I like that. Okay. What are you most curious about right now?
What the big players are doing. I want to know what they're up to because I think they're going dry powder right now, and I'm keeping an eye on them.
Interesting. So if they go dry powder, you're going to go dry powder?
Absolutely. As much as I can. I still got to hold the good assets, but
Yeah.
they're doing dry powder for a reason.
Okay. What is the best piece of advice you've ever received?
Trust but verify.
Yeah.
Yeah. And I take it a step further. I want to know for myself. I kind of learn everything the hard way. So even if I hear things about certain things, I want to know firsthand.
Yeah. Awesome. Well, cool. All right. So Jennifer, one more time, jjcapitalinvestments.com. Your personal cell phone number is on there. You guys can reach out to her if you want to get involved in their fund and tag along and get going after some multifamily investments. Get some cost eggs, some bonus depreciation for the last year, and better get that in quick because it's definitely going down. So, any parting words?
No, just super thankful that I was able to provide some value for your audience. I thank you so much. This is great. I love it.
Yeah, it's been awesome. And guys, you can find out more about the Deferred Sales Trust and other capital gains tax solutions by going to capitalgainstaxsolutions.com. Come to our mastermind every Friday, 10 a.m. Pacific, 1 p.m. Eastern, and you can sign up at capitalgainstaxsolutions.com. And thanks again, everybody, for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and their professional teams struggle to help clarify their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy such as the Deferred Sales Trust or 1031 exchange is the best way to grow your wealth tax deferred. Please rate, review, subscribe. Jennifer, thank you so much for being on the show, and we'll see you next time.